Another day and another flash crash, this time to do with a fake tweet, caused a big swoon in the S&P and the Dow Jones Industrial Average. Welcome to Digits. Here to tell us all about it, Jonathan Cheng of the Wall Street Journal. And Jonathan, the tweet, we're all connected watching the tweets. It had a big effect, right?
That's right. I wish I could tell you everything that happened. We do know that there was a fake tweet. We don't know yet who is behind this or what happened, but we do know that Associated Press, of course, very widely read. They've got a lot of followers. You know, they don't just do financial news, they do a little bit of everything, and they had a tweet out on their feed that said that the White House had been attacked, that 2 bombs had gone off, that the president had been hurt.
Yeah.
That's right. Now, minutes later, the AP took that down and said that they had been hacked. Jay Carney, the spokesperson for the White House, also came out and said this was bogus.
Now, and that, you know, things like that happened. But what happened in the market was we saw on the chart there,
right.
this, and you can see it there, there's the black line. That's the swoon down, this
right.
massive dive in stocks just for a few moments and then back up. Now, this happened yesterday, not with a tweet, but with Google, right? And that was not quite as
that was a 3% drop. This was actually not quite 3%, but this was the whole market. So in some ways, this is more dramatic. We still don't know what was behind Google, but I think if you look at all of the common factors behind these so-called flash crashes, it is computers. It is the fact that the whole system we have now is built on a foundation that is handled a lot automatically and with algorithms.
And of course, you know, a lot of people have so-called sell stops. There's sort of advance orders to sell when the price hits a certain level. And if you saw the price go down, then the stops were triggered. The sell orders go in. It can exacerbate it. But worse than that, today is that you would have sold and it would have gone back up.
That's right. On a day where we're up about 1%, you would have been flat on the day, and that's, you know, not,
and you'd have paid for the privilege.
That's right.
Because you would have paid a bigger commission for that. Now, what we noticed is basically across all asset classes reacted, is what I was hearing. So gold and oil were up as well.
Actually, gold didn't really respond all that much. Forex, we didn't see that much of a move, but oil, we saw a similar move to what we saw in stocks, and we saw the VIX, which is what we call the fear gauge. It measures, you know, trading in futures and options and so on, and basically it showed that there was a big spike in jitters that came right back down again. I mean, I think the final point, of course, is that everything went back to where it was just a few minutes earlier. But in the meantime, yes, if you had a sell loss, you lost out. And even if you're an ordinary investor in this and you didn't lose any money, it's got to shake your confidence again, because we're interconnected and you have a lot of, even if you don't freak out about it, you have a computer doing it somewhere on your behalf, and that affects your portfolio as well. So,
ouch. Oh well, something worth thinking about. Thank you very much, Jonathan Cheng of the Wall Street Journal. I'm Simon Constable, and that was Digits.